big trend, which I'm sure even those not involved in this sector will be well aware of, is the fact that lithium prices have seen a huge dramatic run up over the past year and a half or so. We've now got spot prices on a seaborne delivered basis for both lithium carbonate and hydroxide between $70 to $80 per kilo. And those elevated price levels really reflect the fact that lithium's effectively become the limiting factor in the growth of the battery industry. Fundamentally, the supply side of this market simply hasn't been able to keep pace with the huge acceleration that we've seen in demand. And for the time being, at least, the market does still seem extremely tight. That being said, these price levels are a huge incentive for any existing or would-be producers to accelerate their path to market with new material. And I think that we can expect to see quite substantial increases in supply over the coming years. Whether that will be enough and how long it might take to meaningfully balance the market and result in a sustained downward price correction is really quite difficult to say, and I think only really time will tell on that one. Beyond the price action itself, though, another key trend that we've observed is a change in approaches to pricing. The historical norms of negotiating fixed prices for long-term contracts is fast giving way to a more dynamic pricing structure, where contracts for agreed durations and agreed volumes are instead being linked directly to spot indices for their price settlement. Most prominently, the Fastmarkets CIF, China, Japan and Korea benchmarks for both carbonate and hydroxide. So if you're participating or looking to participate in this market, you really need to recognize that the legacy practices and structures around pricing are fast changing. You'll need to get to grips with the principles of a market-based marginal ton pricing mechanism, understand how indices work and how to apply them in contracts. Beyond that, learning how to access and utilize exchange-based derivatives markets to hedge your prices into the future will also allow you to operate most optimally in this market over the years to come. Furthermore, understanding what exactly an index price represents in terms of its specification and basis and how it was formed is crucial to being able to use it most appropriately in a contract. No two contractual negotiations are ever going to be exactly the same, and in a complex market like lithium, considerations around factors like quality and commercial factors are going to influence the sort of premiums or discounts that might be negotiable above or below a benchmark index. So I'll start answering this one by pointing something out, and that is that in more evolved, more mature markets, including some other battery raw materials like nickel and cobalt, the distinction between spot and contract prices as something different from one another is more or less non-existent. They're effectively one and the same because in those markets, contracts are linked to the averages of spot prices over time. We believe that that is also the future for the lithium market, and note that we can already start to see this shift taking place, although it may potentially take a few more years to play out in full. In the meantime, it's of course important to pay attention to all relevant price points in the market, including both spot and prevailing contract levels. Those looking at lithium equities or looking to value companies along the battery supply chain should absolutely be paying attention to the prices being actually realized under those supply contracts. On the other hand, though, if you're looking to interpret market conditions, then I would argue that the spot price is a much more instructive reflection of market balance at any given point in time. The spot market is where real competitive price discovery takes place. And by contrast, agreements that might have been made months or years ago are, from a price discovery perspective, essentially ancient history. Now, it is true that lithium trade still does flow around the world under quite a wide range of prices in effect. But that being said, if you were to go to the market today with the intention of buying or selling a cargo, then there is very much a price of the day that is going to dictate within a fairly narrow price band the sort of level at which you're going to be able to do that. And that in itself, I think, is something quite significant when we consider how far the lithium market has evolved just over the past few years.